When considering the best ETF investments out there, SCHD often ranks among the top choices for dividend-focused investors. However, a recent article on Seeking Alpha titled, "There's Almost Never Any Reason to Own This ETF" by Daniel Jones has sparked a heated debate. Jones argues that SCHD is a subpar place to allocate capital and is likely to underperform compared to other ETFs like SPY and QQQ. And as a dividend investor, this might make you wonder if SCHD truly deserves a spot in your portfolio. So, is SCHD a good investment? Or is Daniel Jones right about SCHD being a subpar investment? Well, in this video, we will break down the key arguments from Jones's article and analyze whether SCHD is a solid investment choice for those seeking reliable income and growth. So, let's dive into the details. In one of the most controversial articles titled, "There's Almost Never Any Reason to Own This ETF," Daniel Jones challenges the value of the Schwab US Dividend Equity ETF, suggesting that it is not a worthwhile investment choice. And well, this is the guy well known for his detailed and analytical approach to evaluating stocks and ETFs, often focusing on value investing principles. His background includes a deep dive into the fundamentals of various companies and funds, making him a credible voice in the field of investment analysis. Jones's professional background further solidifies his authority on the subject. He runs Crude Value Insights, a value-oriented newsletter that analyzes cash flows and assesses companies' value, particularly in the oil and gas sector. This expertise in evaluating financial statements and understating market dynamics lends credibility to his critiques and recommendations. His focus on value investing aligns with his analytical approach, which often emphasizes long-term financial health and intrinsic value over short-term market movements. He also leverages his analytical skills in his article to argue against holding SCHD. He scrutinizes the ETF's performance, sector allocations, and overall strategy, comparing it unfavorably to broader market indices like the S&P 500 ETF and the NASDAQ 100 ETF. His critique centers on the idea that SCHD underperforms these indices in terms of total return, which combines both capital gains and dividend income. This perspective is grounded in his value investing philosophy, which prioritizes total return over purely dividend yield. However, his critical stance on SCHD has sparked a broader discussion about the merits of dividend-focused ETFs versus broader market funds. His detailed analysis and strong credentials make his arguments compelling, but they also invite further scrutiny. In his article, Daniel Jones presents several arguments against the Schwab US Dividend Equity ETF, contending that it is not an optimal investment choice. He asserts that SCHD is a subpar place to allocate capital, primarily because it's likely to underperform compared to broader market ETFs like the S&P 500 ETF or the NASDAQ 100 ETF. Jones's perspective is built on a series of key points that he believes should deter investors from holding SCHD. Firstly, Jones argues that SCHD's overall performance does not measure up to that of SPY or QQQ. He points out that while SCHD has delivered solid returns historically, its recent performance has lagged behind those broader market indices. Jones emphasizes that SPY and QQQ have consistently outperformed SCHD in terms of total return, suggesting that investors would be better served by allocating their capital to these funds instead. This argument hinges on the notion that total return, a combination of capital gains and dividends, is a more critical measure of an investment's success than dividend yield alone. Jones further critiques SCHD by highlighting its composition. He notes that the ETF has seen significant changes in its sector allocations, with financials and energy stocks becoming a larger portion of the fund. According to Jones, these sectors are more volatile and less reliable in terms of performance compared to technology and healthcare sectors, which have a smaller presence in SCHD. He argues that this shift could expose investors to greater risks and potentially lower returns, making SCHD a less attractive option. Another point Jones raises is the comparison between SCHD and other high-yield investment alternatives. He suggests that investors seeking higher yields could achieve better results by investing in real estate investment trusts, REITs, master limited partnerships, MLPs, and business development companies, BDCs. These investment vehicles often offer higher dividend yields than SCHD, and Jones believes they present a more compelling case for income-focused investors. He acknowledges that SCHD provides a respectable yield, but contends that it falls short when compared to these high-yield alternatives. Jones also questions the long-term viability of SCHD's strategy. He asserts that the ETF's emphasis on dividend growth might not be sufficient to offset its lower capital appreciation potential. In his view, investors who prioritize total return would be better off with ETFs like SPY or QQQ, which have historically delivered higher overall returns through a combination of robust capital gains and modest dividends. This argument is aimed at challenging the fundamental appeal of SCHD to dividend growth investors, suggesting they might be sacrificing significant gains by not opting for broader market funds. Moreover, Jones criticizes the idea of holding SCHD for its lower volatility. He argues that while SCHD may be less volatile compared to other high-yield investments, this perceived stability comes at the cost of lower returns. Jones suggests that investors who are willing to tolerate a bit more volatility could reap higher rewards by choosing funds that track broader market indices. He believes that the trade-off between stability and potential gains is skewed unfavorably for SCHD, making it a less attractive choice for investors looking to maximize their returns. Jones's most substantial critique is perhaps his view on the inherent conflict between dividend investing and total return investing. He claims that the two strategies cater to different investor priorities and that trying to achieve both with a single ETF like SCHD might not be the best approach. According to Jones, dividend investors focus primarily on generating consistent income through dividends, whereas total return investors aim for a balance of income and capital gains. By suggesting that SCHD does not perform well in either category, he questions its overall utility and effectiveness as an investment vehicle. Daniel Jones surely presents a compelling case against SCHD by focusing on its recent underperformance, sector composition changes, and comparison to other high-yield investments. However, looking at SCHD, you might want to take Jones's advice with a grain of salt. SCHD's investment strategy is built on a foundation of stability and reliability, making it a preferred choice for many dividend-focused investors. The criteria for inclusion in SCHD are stringent, ensuring that only high-quality companies make it into the ETF. These criteria emphasize stable dividend payments and large market capitalization, creating a portfolio that balances income generation with financial robustness. To be included in SCHD, a company must have a history of at least 10 consecutive years of dividend payments. This requirement ensures that the companies in the ETF have proven track records of returning value to shareholders through regular dividends. Such a consistent history of dividend payments is a strong indicator of a company's financial health and its ability to generate steady cash flows, which are essential for sustaining and growing dividends. This focus on stability is crucial for investors who rely on dividend income, as it reduces the risk of dividend cuts and provides a reliable income stream. In addition to the dividend payment history, SCHD also requires that eligible companies have a minimum float-adjusted market capitalization of $500 million. This criterion ensures that the ETF includes only well-established companies with substantial market presence. Larger companies are generally more capable of weathering economic downturns and maintaining their dividend payments, making them safer bets for dividend-focused investors. The emphasis on large market capitalization adds a layer of security to the investment, providing investors with peace of mind that their income is backed by financially stable entities. Comparing SCHD to high-yield alternatives like real estate investment trusts, master limited partnerships, and business development companies reveal the distinct advantages of SCHD's strategy. While REITs, MLPs, and BDCs can offer higher dividend yields, they often come with greater risks. These high-yield investments are typically more volatile and can be significantly impacted by economic fluctuations. For instance, REITs are sensitive to changes in interest rates and the real estate market, while MLPs and BDCs are often tied to specific sectors like energy and finance, which can experience significant volatility. SCHD, on the other hand, provides a more balanced approach. The ETF's diversified portfolio includes companies from various sectors, reducing the overall risk. This diversification helps protect against sector-specific downturns, making SCHD a more stable investment choice compared to high-yield alternatives. Furthermore, the focus on companies with strong dividend histories and large market capitalization ensures that the income generated by SCHD is more reliable and sustainable over the long term. Another advantage of SCHD's strategy is its lower expense ratio. High-yield alternatives often come with higher management fees, which can eat into the overall returns. SCHD's low expense ratio makes it a cost-effective option for investors looking to maximize their income without incurring high fees. This cost efficiency, combined with the ETF's focus on stability and reliability, enhances its appeal to income-focused investors. And when you look into the historical performance of SCHD, it highlights its strong appeal to dividend investors, showcasing a blend of reliable income and sustainable long-term growth. You see, SCHD has an average annual return of approximately 12.57% since its inception. This performance is particularly impressive when considering the ETF's focus on dividend-paying stocks, which are typically viewed as more conservative investments. When compared to the broader stock market, SCHD's performance stands out. The average annual return of the stock market, as represented by indices like the S&P 500, is generally around 8% to 10%. This means SCHD has not only met but exceeded the broader market's average returns, providing investors with both robust income through dividends and significant capital appreciation. This combination of high yield and strong growth makes SCHD a compelling choice for those looking to balance income generation with wealth accumulation. However, it is essential to acknowledge that recent underperformance of SCHD relative to the broader market. In the past few years, SCHD has lagged behind indices like the S&P 500 and NASDAQ 100. This recent underperformance can be attributed to various factors, including sector allocations and market dynamic shifts. For instance, the increased weighing in financials and energy stocks within SCHD has impacted its performance, as these sectors have faced challenges in the current economic environment. Meanwhile, technology stocks with a smaller presence in SCHD have driven much of the broader market's gains. Despite this short-term underperformance, the long-term returns of SCHD paint a different picture. Overall, its entire history, SCHD has consistently provided superior returns compared to the broader market, thanks to its strategic focus on high-quality, dividend-paying stocks. This long-term success underscores the ETF's resilience and effectiveness as an investment vehicle for those prioritizing dividend income and growth. For dividend investors, the historical performance of SCHD validates its strategy. The ETF's ability to deliver strong average annual returns while providing reliable dividend income makes it a standout option in the crowded field of dividend-focused investments. Moreover, the long-term outperformance of SCHD relative to the broader market highlights its value proposition, even in the face of short-term fluctuations. So, while SCHD may have experienced recent underperformance compared to the broader market, its historical performance remains robust. With an average annual return of 12.57%, SCHD has outperformed the stock market's typical returns, offering investors a unique combination of dividend income and capital growth. This track record reinforces SCHD's position as a top choice for those seeking a balanced approach to dividend investing. capable of weathering market volatility while delivering substantial long-term returns. So now, what are your thoughts on SCHD? Does it deserve a place in your investment portfolio? Share your opinions in the comments below. If you found this video helpful, please give it a thumbs up, subscribe, and turn on the notification bell for more amazing videos.